Good afternoon. I'm Vinay, founder and CEO of Hashstack. A brief about us, we provide on-chain under-collateralized loans up to 300% your collateral. We are currently live on BNB chain and will be releasing a Starknet version in the next couple of days. In today's topic, Hashtack and under-collateralized lending in DeFi, I'll briefly touch upon the current state of DeFi, its bottlenecks, and where we fit. So let's dive in. Today, if we take a look at the DeFi ecosystem in general, the entire products that are built in this space can be basketed into two baskets, one that serves the retail, another that serves the institutions. For the institutions, you would see solutions such as Maple Finance, TrueFi, Goldfinch, and for the retail, you have pioneers such as Compound, Aave, MakerDAO. The main differentiator between these two baskets, apart the fact that they serve totally two different user segments, being the fact that the institutional focus, the ones that focus the SMEs, they offer under-collateralized loans, while the ones that serve the retail, they are largely over-collateralized. And this is probably due to the fact that the on-chain activity of the retail users is largely restricted, the inability to profile the borrower, the debt recovery risk, etc. Now, as a solution to this, as in response to this, there are new set of solutions that are being developed, and they can further be classified into two baskets. One that uses your online reputation by marrying your online activity with your wallet to determine a credit worthiness of your particular wallet, and two that tries to mimic credit scores on the blockchain by using a FICO model. Now, coming to these two solutions again, considering less than 1.5% of today's population is still, have used DeFi, the on-chain activity is largely restricted, and any form of credit score that is thus derived is unreliable. So this makes both of these approaches impractical, and thus there's an opportunity. The opportunity being over-collateralized lending restricts the mass adoption, while under-collateralized lending through credit score is not practical today. And before we dive into the solution, let's take a look at how the TradFi entities such as banks approach to this problem. And for this, let me give you a quick example as to how the lending works for the informal sector. So let's say there's an individual called John, and he has inconsistent employment and inconsistent finances, but he wants to purchase a tuk-tuk to generate livelihood. So he saves up about $2,000, and the cost of the tuk-tuk in India, it's called as auto, is about $5,000. So he goes to the dealer, and the dealer facilitates a conversation with a banker who agrees to finance the remaining $3,000 so that John can purchase the tuk-tuk. Now, in this transaction, the bank pays $3,000 to the dealer, and John adds $2,000 from his end. John walks away with the tuk-tuk, and dealer gets $5,000 worth of the $5,000, that is the cost of the tuk-tuk, in his pocket. Now, in this total transaction, if you observe, this is under-collateralized loan, wherein it met a specific objective because John met the requirement he needed with regards to the loan, and he ends up paying the monthly installments to the banks. Now, this got us thinking, because this is a similar approach entities such as banks, they adopt when it comes to giving out loans for home, for education, etc. So we wanted to see if we can mimic this solution to enable under-collateralized lending in DeFi. And as it turns out, it is possible. So the solution being Hashstack, as we established, we enable our users to borrow up to 300% the collateral as loans. And at this moment, we are the only product in the entire ecosystem that's enabling this. And our loans are designed to encourage productive lending, wherein our users, our borrowers, can utilize the loans they get for personal finance and trading capital needs. And these are the two of the most required use cases our borrowers said to have when it comes to approaching DeFi lending providers. Now, there are 4 users who are a part of the entire chain: the liquidity provider, who are depositors, the borrowers, the liquidators, and the protocol itself. Among these 4 users, the borrowers are the ones I'm going to give you a quick walkthrough about how it works, because these are the ones who generate value for the rest of the 3 users. Now, giving a simple example, let's say there's another user called Vinay, who is me. And this user comes to open, Open is the name of the protocol. And this user can borrow up to $300 with a collateral as little as $100. Now, he has an option to spend this loan into two ways. One, he can withdraw a portion of the loan into his personal wallet while keeping the remaining loan as a trading capital, or he can utilize the entirety of $300 loan as a trading capital. So the maximum permissible withdrawal into a personal wallet does not exceed 70% of collateral, that is $70. So the remnant balance that stays within the protocol is owned by the protocol, with you, the borrower, has the right to spend. To enable effective loan spend, we integrate applications across different L1s and L2s. We curate the applications, we curate the functionalities within those applications. And if, as a matter of fact, let's say Vinay ends up investing on a coin, taking a long position on DYDX, and if the trade goes north, the profits are his to keep. And if the trade goes south, considering the protocol owns the funds, the protocol has an option to liquidate that position in order to recover itself. However, for the sake of transparency, it delegates this task for the third stakeholder, known as liquidators. So this definitely begs the question, what are the risks? The primary risk as to why rarely any other product tries under-collateralized loans for the crypto retail being the debt recovery risk. But the fact that the protocol does not seed more than 70% of the borrower's collateral into the borrower's wallet gives the protocol the authority to secure itself in the event a loan goes south. And hence, we can mitigate debt recovery risk. KYC is not mandated as of now, but till the debt position is about $100,000. In general, we factor in various risk theses, primarily with regards to securing the liquidity providers, securing the protocol, and of course the overall process in itself. I'll simply list down a few of them. So there is a function called permissible CDR. When a user tries to borrow a loan, this is a function that determines what is the borrowing capacity the user has. And this is based on the various parameters, such as the borrower's relationship with the protocol, the computational feeds such as implied and realized volatility of the collateral, the the loan, and the available asset resource. So permissible CDR determines how much a user can borrow from the protocol at any given point in time. Price feeds. If you're familiar with the recent arbitrage hack on GMX, we are foolproof for that particular hack. We have a dual price feed mechanism wherein we use general price oracles such as Empiric to fetch the general purpose price for an asset. We also use a fair price mechanism that relies on product constant formula to determine what is the executable trade value for any particular asset from asset A into asset B in the case of liquidation, in the case of borrowing a loan. Apart this, there are a few other risk theses we have at this moment, but for the sake of time, I'll restrict myself. Now this brings the question, can they scale? So today, there is an over-collateralization problem. Under-collateralized loans through credit score is not practical today, and you are a middleware solution. So what if tomorrow crypto goes mainstream? Can you guys still survive? The answer is yes. The entire product is designed as modular. In the sense, today we are able to offer up to 3 times the collateral as loan. But as the mass adoption grows, we are in a position to build our own credit risk oracle, wherein we will be able to give out loans in excess of 3 times the collateral. And in some occasions, we will also be able to give out loans without any collateral backed by real-world assets. And closing in, at this moment, we are live on BNB chain, and we're launching on Starknet this weekend. We have acquired over $356 million in testnet liquidity, spanning 40,000 plus on-chain transactions. But the single most validator for us is the asset utilization. For us, the asset utilization is 63%. That is, for every $100 deposits we have, we are able to deploy $63 as loans. This, when we compare with the incumbent players such as MakerDAO, Compound, or Aave, they do not exceed $40. So we have at least 57.5% higher asset utilization without diversifying the asset utilization in comparison to our current competitors. So with that being said, thank you for your time.